In this video, we are going to provide a comprehensive guide on how to master candlestick charts with speed and precision. Here's exactly what we will be covering today. As always, if you find this content valuable, please hit the like button. It directly supports our team in producing more high-quality educational videos on YouTube. The anatomy of a candlestick. To start, let's break down how to actually read a candlestick. Green candles are bullish, indicating that the price appreciated and moved upward during that specific time frame. Conversely, red candles are bearish, signaling that the price depreciated and moved lower. The rectangular center of the candle is known as the real body. The thin lines extending above and below are called wicks, shadows, or tails. For bullish green candles, the opening price is located at the bottom of the body, while the closing price is at the top. For bearish red candles, the opening price is at the top and the closing price is at the bottom. The tips of the wicks represent the extreme price action of that period. The top wick marks the highest price reached, and the bottom wick marks the lowest price recorded. Understanding momentum through body size. The size of a candlestick body is a vital indicator of market strength. A large body represents a significant gain in momentum, as the price traveled a great distance during that period. A small body indicates a loss of momentum, as the price movement was much more restricted. When a candle has an extremely small body, or no body at all, it is called a doji. This represents indecision between buyers and sellers. During this time, the price may have swung up and down significantly, but it eventually closed very near its opening price, showing that neither the bulls nor the bears gained any ground. Candlesticks are essential because they tell the story of market participants. The patterns they form reflect the real-time psychology of buyers and sellers, which is why traders use this price action to make informed decisions. Navigating the charts. Let's apply this to a real chart using Apple stock as our example. On the top left, you will see the time frame. Currently, it shows 1D, meaning the daily time frame. Every individual candle represents one full day of trading. If we switch to 1W, weekly, or 1H, hourly, each candle would represent 1 week or 1 hour, respectively. The horizontal bar at the bottom displays the date and time. By hovering your mouse over a candle, you will see dotted lines connecting it to a specific date, such as January 3rd. Moving one candle to the right brings you to January 4th. The vertical bar on the right shows the asset's price. For a green candle, placing your mouse at the bottom of the rectangle shows the opening price, for instance, $100 to $26.05. Placing it at the top shows the close, such as $129.61. This indicates the stock appreciated by $3.56, signaling bullish interest. The wicks will show you the intraday extremes, like a low of $124.90 and a high of $130.30, analyzing trends and market direction. Conversely, for a red candle like the one on January 3rd, the opening price is at the top, $130.24, and the close is at the bottom, $125.13. This $5.11 depreciation represents bearish price action. If you wish to use the same professional charting platform seen here, visit my channel on description. When red candles outnumber green candles, the asset is in a downtrend, showing depreciation as sellers dominate. When green candles prevail, it is an uptrend, showing appreciation as buyers drive the price higher. Groups of same-colored candles indicate strong directional momentum. However, a mix of colors moving horizontally signifies indecision or consolidation in a choppy market. We want to hear from you. Tell us in the comments which topics we should cover next. Master price action. Access our premium technical analysis and start trading like a pro today on description. Identifying trend changes. An uptrend is defined by a series of runs and pullbacks, creating higher highs and higher lows. In this environment, traders generally look for long buy entries to align with the bullish momentum. However, trends eventually shift. There are three main types of trend reversals from up to down. Type 1, price forms a lower low. Type 2, price forms a lower low followed by a lower high pullback before breaking down further. Type 3, price forms a lower high first, signaling exhaustion before the reversal. A downtrend consists of lower highs and lower lows. Here the sellers are in control, and traders typically look for short sell opportunities. To spot a reversal back to an uptrend, look for higher highs or higher lows to form. signaling that the bulls are regaining control. In a sideways or ranging market, the price oscillates between the same highs and lows. In these scenarios, traders may look to trade both directions with confidence as price bounces between established boundaries. Spotting momentum, gain and loss. There are two primary ways to identify momentum gain. First, look for tight price movement. If price moves steadily in one direction without wide counterswings, one side is in absolute control. Second, look for candles that are growing in size. As each candle covers more distance than the last, it signals accelerating momentum. Conversely, momentum loss can be identified in three ways. Wide swings. When tight movement is replaced by volatile wide swings, it suggests the dominant side is losing control. Shrinking candles. If candles progressively get smaller, the distance traveled per period is decreasing, leading to a potential reversal. Color change. After a long string of same-colored candles, the appearance of an opposite color indicates that the trend has failed to produce a new extreme, signaling exhaustion. Take your trading further. We host a wealth of exclusive content there that will never be available on YouTube. Thank you for watching, and we will see you in the next episode. Get the ultimate trading blueprint. Join our community and gain access to high-probability trade signals.